We are starting with non-current long-term liabilities. Now, example 2, lease identification and classification. So these are the 5 points in order for the lease to be considered to be a financial lease. Now, company C enters contract with company D that requires company C to pay 100 million at the end of each of the next 2 years to company D for exclusive use. Now, this word is exclusive use of specific machine over that time period. So company C is using this machine, and it has specific this exclusive use of specific machine over the time period. So hence this is a lease. Either it is an operating lease or finance lease. So we need to see that any one of the criteria is being met. So at the end of the contract, company C will return the machine. So the lease transfer ownership of the underlying asset to the lease, and the lease has an option to purchase the underlying asset and is reasonably certain it will do so. So over here at the end of the contract, company C will return the machine to company D. So again, this is indicating it is not a finance lease. The contract does not contain an option, purchase option. Again, it is not a finance lease. The machine can be used in many applications by many types of customers, and the remaining useful life of the machine is 4 years. So again, the lease term is for major part of the asset's useful life, so it's only half. Now, the present value of the sum of the lease payment equals or exceeds substantially all of the fair value of the asset. So the present value of the sum of the lease payment equals or exceeds substantially all of the fair value of the asset. So the remaining useful life of the machine is 4 years, and its fair value is 190 million. Now this contract is what? So the present value of the payment is 186. So 186 divided by 190 is approximately, I guess, 98%. So 186 divided by 190 is approximately 98%. So it's quite a substantial amount. Now this is more than 90%. So if this is more than 90%, then it would be considered to be a finance lease. And if the fair value of the machine in question one is 300 million, so 186 divided by 300 million, so it's approximately 186 divided by 300, it's approximately 62%. Now it is not like the present value of the sum of the lease payment equals or exceeds substantially all of the fair market value of the asset. So it's not, first of all, it's the present value of the payment is only 62% of the fair value of the asset, so it wouldn't be considered to be a finance lease. So so we need to, would the classification of the contract change? Yes, it will change from finance lease to operating lease. So the contract is a finance lease because one of the 5 criteria is met. The present value of the lease payment equals or substantially all of their fair value. Now, example 11, lease accounting in IFRS. So in IFRS, there's a single accounting method for both. There's a single accounting method for both operating lease and finance lease. So either it is an operating lease or a finance lease. So these are your assets and these are your liabilities. So your liability will increase and also your asset will going to increase. So in your asset we'll be writing return, we'll be writing right of use. So this is the right of use over here, ROU, and over here we'll be writing present value of lease or your liability, present value of your liability or your lease payments. Now, Proton Enterprises, a hypothetical manufacturer based in Germany, is offered the following terms to lease a machine: a 5-year lease with an implied interest rate of 10% and an annual lease payment of 100,000 per year payable at the end of each year. So 1, 2, 3, 4, 5. So the present value of the machinery is therefore 379,079. So present value is 379,079. So this would be recorded in assets. Right of use 379,079, and present value of liability is also 379,079. Now the asset will be amortized over the 5 years lease term on a straight line basis. Now Proton reports under IFRS. What would be the impact of the lease, of this lease on protons? So balance sheet at the beginning of the year. So the balance sheet at the beginning of the year would be 379079, and income statement during the following year. Now you need to understand that at the end of 1 year, how much payment we are doing? We are doing 100,000 worth of payment. Now out of this 100,000, there would be a component that would be interest component, and the other component would be principal component. So at the end of 1 year, the interest component should be 37,900, so 10% of 379079 would be how much? 379079 multiplied by 0.1, so it would be 37,907.9. And your principal component would be, you subtract 100,000, you will be getting 62,092.1. So your outstanding liability would be 379079 minus 62,092.1. So in the next table we will be we have come up with this table in which we are amortizing it, and this is your amortizing table as well. So 100,000 is your lease payment, interest expense is 37,908, your outstanding principal would be subtracted by 62,092 because that's your principal repayment. So the lease liability at the end of the year would be 316,987. Same the case, next year your interest would be how much? 316,987 multiplied by 0.1 is 31,699. If we subtract this by 100,000, we'll be getting 68,301. And 68,301, if we subtract this by 316,987, we will be getting 248,685. So this is how we come up with your amortization table, and your lease liability is reducing by 62,092 in the first year, 68,301 in the second year, and so on. And on your asset side, your asset would be depreciated. So it would be depreciated by by straight line method. So 379,079 divided by 5 is 75,816. So each year it would be reduced by 75,816. So 379,079 divided minus 75,816 we're going to give you 303,263. You minus 75,816, you will be getting 227,447. Now your last part is statement of the cash flows during the following year. So again, we are paying 100,000. So out of this 100,000, there are two components. One is interest component, the other one is principal component. So principal component would be subtracted from cash flow from financing activity, and interest component would be subtracted from either cash flow from financing activity or cash flow from operations. So principal repayment are reported as cash outflow under the financing activity on the statement of cash flows, and depending on Proton's reporting policies, interest expense is reported under either operating or financing activity on the statement. So year 2 principal repayment is 68,301, and the interest component would be 31,699. Now lease accounting, operating lease under US GAAP. Now in US GAAP there are two different methodologies. So one methodology is that we do finance lease, and the other one is operating lease. Now in finance lease, it's similar to what we have done in IFRS. So we have assets and we have liability. So assets will be created right of use and your present value of liabilities, and your right of use would be deducted by your depreciation, and present value of liability would be deducted by or subtracted by your principal repayment. So this is the same table we came up in the previous question. So right of use of asset, that's 303,263, 227,447. That's your end of year 1, end of year 2. Now from where we are getting these numbers? So again, these numbers are coming from here. So 379,079, that's your asset at the start of the year, and we are subtracting the depreciation, that is 75,816. So if I subtract 75,816, I'll be getting 303,263. And lease liability. Now we are at the end of the year, your liability is 316,987. So how do we get this number? So again, at the start of the year, your lease was, or the present value of liability was 379,079. You subtract the principal repayment, you will be getting 316,987. So this is how you come up with your liability. Now under operating lease, again we will be creating, we have assets and liability, will be having right of use, and we will be having present value of liability. Now right of use and present value of liability both would be subtracted. Now this is the trick over here. Now both would be subtracted by principal repayment. And if you look closely over here, we are getting for both these numbers, we are getting 316,987, 316,987. That's right of use, that's on your asset side. Lease liability, 316,987 for both of them. How do we get these numbers? 248,685, 173,554 by deducting what? Your principal repayment. Now this is again a very important point. The right of use is lower in each period under the finance lease. So the right of use is in right of use and assets over here is lower. Why? Because over here we are deducting depreciation. Depreciation was 75,816, and each year over here we are deducting over here the principal repayment. So we deduct 62,000 over here. So 379,079 minus 62,092 would be obviously more than deducting 75,816. But anyhow, at these points, your principal repayments are more, but nevertheless, your right of use and finance lease is less as compared to that of your right of use and operating lease. Now, right of use assets and is lower in each period under finance lease. This is what we have discussed. And now what we have to discuss, what will be happening in the income statement. Now, in finance lease, now this is the very important point. We have finance lease and operating lease. So we are paying total 100,000. In finance lease, we'll be first deducting what over here in your right of use, we deduct your depreciation. So we deduct depreciation, and we'll be having EBIT, earning before interest and tax, and then we subtract interest, and then we'll be getting EBIT or net income after deducting your tax. Now in operating lease, what's happening? In operating lease, there is only one expense, that is your lease expense, that is of 100,000. That is your lease expense. Now we have deducted whole 100,000, and then we are getting what? EBIT. Now EBIT or EBITDA, either the case, because it's again before interest, and we don't have any interest over here, and then we'll be having net income. If you look closely, your EBIT in your finance lease or EBITDA in your finance lease would be higher. Why? Because we are only deducting 75,816, 75,816, but over here we are deducting the whole 100,000. Now EBITDA would be more. Every time EBITDA would be more in finance lease as compared to EBITDA or even EBIT in your operating lease. But in your initial years, if we talk about net income, your net income in operating lease would be higher than net income in your finance lease. Why this is the case? Because if we in your net income, we also are deducting interest. So if we deduct interest, we get 113,724. Depreciation plus your interest is more than 100,000. Depreciation plus interest is more than 100,000. Depreciation plus interest is more than 100,000. So we are deducting all of this, and then we are getting net income. So in early years, your net income in your operating lease is higher as compared to net operating in finance lease. But later years, your net income would be higher in finance lease as compared to net operating in operating lease, because depreciation plus interest is less. So this is again extremely important point. And the last point is that of your cash flow. So what do we need to do with your cash flow? So in your operating lease, it's quite simple. This 100,000 would be deducted from your operating activities. And in your finance lease, we have again two components. We have interest component and principal repayment component. So interest component would be deducted from your operating activities, and your principal component would be deducted from your financing activity. So this is how we do it under US GAAP. And what will be happening to our ratios? EBITDA margin, so impact using an operating lease instead of finance lease. So if we are using operating lease, so we know that EBITDA and operating lease, EBITDA and operating lease is less. So the numerator is less in operating lease, because only in a finance lease only depreciation is being deducted, and depreciation is only 75,816 in order to get EBITDA. In operating lease, the whole 100,000 is being deducted in order to get your EBITDA. So EBITDA in operating lease is less. So your EBITDA margin would be lower as compared to that of your finance lease. Asset turnover, that's your total revenue divided by total assets. In your operating lease, now look what's happening to your assets in under operating lease. So your operating lease assets, as we have discussed before, are much higher than the assets in your finance lease. Why? Because in finance lease we are deducting 75,816, and in your operating lease we are deducting 62,092 in order to get your assets. So 62,092 is your principal repayment. So your assets under operating lease are lower. Assets under operating lease are assets under operating lease are higher. Assets under operating lease are higher. So assets are higher in operating lease, so this ratio would be lower. Why? Because your denominator would be higher. And cash flow per share, so cash flow from operations in your operating lease would be lower. Why? Because the whole 100,000 is being deducted from your operating activities. And the last question is, what will be happening in lesser accounting? So that's example 13. So let's examine Proton's machinery lease from example 11 and 12 from the perspective of the lessor. Assuming that the carrying value of the asset immediately prior to the lease is 350,000, accumulated depreciation is 0, and the lessor elects to depreciate it on a straight line basis over 5 years. So how the lesser financial statements affected by the classification of the lease as a finance or operating lease? So if it is a finance lease, then we remove the asset from the lessor's finance lease from the lessor's perspective. So we remove the asset from the lessor's balance sheet, because now the asset is transferred to the lessee's balance sheet, and we add what? Lease receivables. And the lease receivables would be, every year it would be deducted by principal repayment. So the principal repayment that is the lessor is getting, the lease receivables would be deducted, and interest income would be reported in income statement, and cash flow from operation would be whatever the cash flow receipts the lessor is getting will be going to cash flow from operations. So any cash flow receipts would be included in cash flow from operations. And if it is your operating lease, then the asset will remain in the lessor's balance sheet, and it will be deducted by the depreciation, and any cash receipt would again be reported in your cash flow from operations. Now over here again, the difference on the balance sheet is material, because in a finance lease requires the lessor to re-recognize the asset and recognize lease receivable, whereas in operating lease lessor continue to recognize the asset and depreciate it over its useful life. In the case where the present value of lease payments is well above the carrying value of the asset, so asset has been removed and the lease receivable will be quite high. So the finance lease classification results in a significant increase in assets for the lessor. So that's it for today.